What if I told you there is a market you have never looked at once in your life that is quietly deciding your mortgage rate, your retirement balance, and whether your employer can afford to keep you on payroll? It is $145 trillion in size. It operates around the clock, and most people have absolutely no idea it exists. By the end of this video, you will understand exactly how it works and what every single move it makes costs you in real dollars. So what actually is a bond? Strip away all the financial jargon, and a bond is just a loan. A government, a corporation, or a city needs money. Instead of walking into a bank, they borrow directly from investors like you. You hand them a fixed sum called the principal. In return, they promise you two things: a fixed interest payment every year called the coupon, and your full principal back on a specific end date called the maturity. That is literally the whole thing. It is a piece of paper that says, lend me money today and I will pay you interest every year until I give it all back. Simple concept, but the scale at which it operates is anything but simple. And the scale is exactly what makes this matter to your wallet right now. Here is the one rule that governs everything else in this video. When interest rates rise, the price of existing bonds falls. When rates fall, bond prices rise. They always move in opposite directions. No exceptions. Here is why that happens. Say you buy a bond for $1,000, paying 3% annually, so $30 a year. A few months later, new bonds hit the market paying 5%, meaning $50 on the same $1,000. Nobody is going to pay full price for your older, lower-paying bond anymore. To sell it, you have to drop the price until that $30 payment becomes competitive at the current 5% rate. That price lands around $600. Your principal payment at maturity is still intact, but on paper, your $1,000 investment just became worth $600. Keep that rule locked in because everything that follows depends on it. And the stakes are about to get very, very personal. Let me show you exactly how this hits your mortgage. When a bank decides what rate to charge you on a home loan, it does not invent a number. It looks at the yield on the 10-year United States Treasury bond and asks why it would lend money to a regular household for 30 years when it can lend to the government risk-free. The answer is it would not, unless you pay more. So the bank takes the 10-year Treasury yield and adds roughly 2 percentage points to cover the risk that you might lose your job or miss payments. Right now, the 10-year Treasury sits around 4.5%. Add 2 points, and you land at roughly 6.5% on a 30-year mortgage. That math is that direct. But here's where it gets alarming for anyone who has bought or is thinking of buying a home. Take someone with a $400,000 30-year mortgage at today's rates. Their monthly payment is around $2,500. If the 10-year Treasury yield rises by just 1 full percentage point, which the bond market can accomplish in a matter of weeks, that same mortgage now costs nearly $270 more every single month. Over the full 30-year life of the loan, that one move in a market most homeowners have never opened costs them close to $97,000, and they never received a single notice. But the bond market's power over your money does not stop at your front door. For decades, financial advisors told people nearing retirement to shift out of stocks and into bonds for safety. Bonds were the seatbelt. The classic 60% stocks and 40% bonds portfolio was the conservative default. Then 2022 happened. The Federal Reserve raised rates faster than at any point in 40 years, applying the rule we just covered. Rising rates crush existing bond prices. The broad United States bond market lost 13% that year, the worst calendar year on record going back to 1976. Long-dated Treasury bonds lost nearly 40%. Researchers found 2022 was the worst year for long-duration U.S. bonds, going all the way back to 1754. The colonies were still under British rule, and America's retirement portfolios were experiencing their worst fixed income disaster in nearly 3 centuries. So what determined who got absolutely wrecked versus who only got bruised? The answer is one number called duration, printed on every bond fund fact sheet, where almost nobody ever reads it. Duration tells you roughly how much your fund loses for every 1 percentage point rise in interest rates. A broad bond index fund with a duration of 6 loses about $30,000 on a $500,000 investment when rates climb 1 point. A long-dated treasury fund with a duration of 17 loses $85,000 on that same amount in that same rate move. Same investor, same money, $55,000 difference, all because of a number most people skip right past. Knowing your duration is not optional if you own bond funds, but there is still one more layer to this that can actually help you make money while everyone else is losing it. There is a chart called the yield curve that has predicted every single American recession going back to 1955. 10 recessions, 10 for 10. It works by plotting treasury yields from 3-month bills all the way out to 30-year bonds. Normally the line slopes upward, longer loans pay more because more can go wrong over time. But occasionally the curve inverts, meaning short-term bonds pay more than long-term ones. When that happens, the bond market is signaling it expects the economy to weaken badly enough that the Federal Reserve will be forced to cut rates. No other economic indicator has matched that track record across 7 decades. And right now, that same market is offering most savers something they are completely ignoring. The average savings account at a major bank currently pays around 0.38% annually. 3-month treasury bills right now yield over 3.5%. The best high-yield savings accounts push past 4%. All three carry essentially identical safety. T-bills are backed by the United States government, and high-yield savings accounts carry FDIC insurance up to $250,000. If you hold $50,000 in a standard bank savings account, you earn about $190 a year. That same $50,000 in treasury bills earns nearly $1,900 annually, almost 10 times as much, with zero additional risk, and T-bill income is exempt from state income tax on top of that. Every year that gap goes uncaptured is money left permanently on the table. Here is where to start right now. If you own bond funds in any retirement account, pull up the fund's fact sheet and find the duration. Anything above 7 means your fund moves meaningfully when rates shift. Above 15, and you essentially own something that behaves like a volatile stock, not the safe harbor you were promised. If inflation is your primary concern, Series 1 savings bonds currently yield 4.26% through October 2026. Adjust automatically with inflation and are available through Treasury Direct with a $10,000 annual limit per person. And the 10-year Treasury yield, the single most important number in all of personal finance, takes about 5 seconds to look up from anywhere. The bond market is not a thing designed for wealthy institutions. It is the invisible engine setting the price on your mortgage payment, your savings account return, your retirement fund performance, and the borrowing costs of the company you work for. Every dollar in your financial life passes through it at some point. The people who actually understand how it works are not smarter than you. They simply stop treating it like something too complicated to care about. Now you understand it too. If you found this useful, hit the like button and subscribe so you catch the next one, because the numbers we cover here only keep getting more important.